but my mama didn't raise a fool. And if she did, it was one of my brothers. And what you're doing, you know it and I know it, and all those people sitting behind you know it. You're paying 5% to borrow money when you could pay 4% to borrow money. You announced you were going to do that back in November 2023. You're working cross purposes with Jay Powell, who's trying.
We're not working.
And the reason you're doing this, is try to give the economy a sugar high 5 months before an election. Now, you know that, and I know that.
There's nothing about issuing short-term debt that creates a sugar high for the economy.
My chairman says I'm out of time. It's good to see you.
This is the single most important real estate story that there is. It's not the big, beautiful bill. That's important, but what they're doing with debt. And when you hear Scott Bessent in just a minute, it becomes much more clear that something afoot is in the air. There could be massive downward pressure on mortgage rates. And it makes sense that Trump is reportedly now saying stocks could go up from here.
The stock market's at an all-time high. Jobs are at an all-time high. Everything's at an all-time high. And we're going to keep it that way.
Now, this is a huge update from my last video. Donald Trump in 3 interviews last week said no to long-term debt. It made me wonder, is Scott Bessent in the loop on this? Is Trump going full maverick, or is it a tag team effort and a true policy move? Now, I'm going to play a clip where Scott Bessent answers this question directly.
At what point do you start issuing at longer dated maturities?
Well, we're more than one standard deviation above the long-term rate, so why would we do that?
They potentially don't want to issue any more long-term debt this year. That would be effectively shelving $3.3 trillion of long-term debt. This would be the biggest QE in history, but through the Treasury and not through the Fed. Now, it is important to note that since this interview, they did actually make an auction announcement and they didn't deviate from the original plan. So far they haven't changed anything, but that was before the big, beautiful bill was passed. So how will this impact markets, and is this good policy or bad policy? Well, let's first take a look at the policy, then we'll talk about how it could impact bonds, stocks, mortgage rates, and gold. Initially, this strategy started with Yellen shifting bonds to bills in Q4 of 2023. And at the time, I dismissed it as a silly tactic. I remember Andy Constant tweeting saying Janet just saved Christmas. I thought he was crazy, but I paid attention. And he was right. What did he understand about what she did?
There's nothing about issuing short-term debt that creates a sugar high for the economy.
My chairman says I'm out of time.
Now, turns out the Treasury's version of QE is just a lot of reducing long-term debt issuance and shifting that to the short-term debt. And look, if you have a lot of buyers wanting to buy long-term debt and there's not much there, then they're going to push up the price of that and reduce the interest rates. And that's exactly what Janet Yellen did. She just shifted the new issuance to bills or short-dated maturities. So let's take a look at this blog article by Florian Kronewitter. Let's just see what he has to say, because I think he'll explain it much better than how I understand it. Now, let me preface this, and he does too, to say that what they are planning to do is very poorly understood. And it's obvious when nobody talks about a major policy change, it's because nobody really understands it. And this is why it's probably not getting much attention, but I guarantee you if they do this, everyone's going to be an expert on this subject by the end of the year. So let's start with the key points. First, we need to know that interest rates on long-term debt are decided by the market. Think about when the Fed cut rates last year. Mortgage rates went up.
Well, Kelly, after a 21 basis point jump yesterday following the Fed meeting, the average rate on the 30-year fix moved even higher today to 7.14%, according to Mortgage News Daily.
The Fed doesn't decide long duration. However, the short-term debt is decided by the Fed. Now, this is where things get interesting. If the administration installs a Fed chair who follows its interest rate demands, the Treasury mostly issues short-term debt. It could effectively decide the interest rate it pays on this debt. This would save the government hundreds of billions of dollars potentially. And who might be a leading candidate for that position, you ask?
You know, your name gets floated out there. You have some odds on Polymarket of being the next Fed chair. Can you be a Fed chair and a Treasury secretary at the same time?
Well, I think it hasn't been done since 1930-something, and I'm very happy in my job here. I think we have lots of good candidates for Fed chair. We will start working on that in the fall. We've been busy. The president's been doing peace deals, trade deals, tax deals, and we are landing the plane on all of those. So we're going to have more bandwidth after Labor Day.
That was not a no, I just want to point out, on the double job. Very interesting.
Who has the greatest interest in seeing interest payments drop? Scott Bessent. That's right, the Treasury Secretary himself. Now, if the issuance of long-term debt is greatly curtailed, long-term yields will drop below their natural level. It's really important that you realize it's the natural level. It's downward pressure. What the markets decide in light of growth and inflation expectations, it would be lower than that. And this is very stimulative to the economy. Think about corporate debt issuance or housing, which means it could be 7%, but it's going to be lower than where it should be. Now, the strategy itself is called fiscal dominance. And before you cheer it on, it's mostly well known in emerging markets where the government has given up on budget discipline and just prints money it needs to finance the deficit, ignoring price stability risks. Now, we might see structurally higher inflation, currency debasement, and potentially political crisis as the wealth gap will continue widening because of this policy. But it's also possible that forcing interest rates lower may not actually be as bad as it sounds. If Jerome Powell truly is too late, then this could provide stimulative boost as things are beginning to unravel. Second, in a perfect world, it would be ideal to rein in the humongous U.S. budget deficit. However, cutting it back would be very quickly introduce a downturn, not to mention the political consequences of a recession. In some ways, playing offense may be the only realistic way out. And by the way, this is the strategy openly embraced by the Trump administration. Grow your way out of the debt. Push the debt to the short end, drop rates low, and reduce deficit spending using the Fed. So how could this impact stocks, housing, and U.S. debt? Now, here's what Flynn says. Long-term bonds, in past precedents, the immediate consequence from significantly lowering bond issuance was, unsurprisingly, lower long-term yields. This was true for Japan in the 2000s and 2010s, as much as it was true for Janet Yellen in Q4 of 23. Hey, I wanted to make sure I clarified this point. Lower long-term yields means we could have a much lower mortgage rate than what should be. This means it could be a lot lower, or it could mean that inflation goes up and mortgage rates stay flat. Either way, it's going to be much lower than what it would be otherwise. Fiscal dominance puts a lot of downward pressure on the financial system as the government inundates the economy with liquidity via cash like T-bills. This is essentially money printing. It's different than long-term debts. And by the way, I know some of you are saying, well, but Ethan, in real estate, what about supply and demand? I'm not trying to dismiss that, but let's take a look at the currency that you're purchasing those with. You see, the US dollar has already dropped 10% against other currencies this year, and Scott Bessent made some wild comments about that too. If you think the strong dollar policy is in play, you may want to hear what he has to say about that.
The price of the dollar has nothing to do with a strong dollar policy. Is another currency stronger, higher in price at the moment? That doesn't have anything to do with a strong dollar policy. The strong dollar policy is, are we doing the things over the long term to ensure that the U.S. dollar remains the reserve currency of the world? And we are.
DXY has been dropping, and it could continue to drop. A rapidly declining US dollar will soon be a headache for all the other currencies, especially if they are heavily export driven. So they'll be forced to also cut rates and be dovish. This phenomenon is called competitive devaluation and needs another escape valve, in this case, gold. Now, equities, here's where it gets a bit more complicated. US stocks in particular face a two-way dynamic. Positive is the amount of US dollars grows much faster than the real assets around. However, historically, an imploding currency has led to capital flight by foreigners who incur significant losses via the FX move. Again, this is probably why Bessent is talking about a strong dollar policy. He doesn't want to lose capital flight, but he's still willing to devalue the currency. And look, they're telegraphing their plan. Okay, so let's watch and see. So far, they haven't changed any debt strategy, but now that the big, beautiful bill has passed, now that it's crossed the finish line, what are they going to do with auctions? It's very important that we pay attention to this. Thanks for watching. I look forward to seeing you next Saturday.